Hello, my name is Jingonelli, and today we're going to be looking at transfers under IAS 40, which is investment properties, and this is as of 2022. So, what do they mean by transfers? Transfers to or from investment property should be made when there is a change in use. For example, owner occupation commences. So the investment property will be treated under IAS 16 as an owner occupied property. So what does it mean here? So what is the meaning of owner occupied property? So this is property held by the owner or by a lessee under a finance lease for use in the production of supplier of goods and services or for administrative purposes. So when there is a transfer from investment property carried at a fair value to the owner occupied property or inventories, the property's cost for subsequent accounting under IAS 16 or IAS 2 should be its fair value at the date of change of use. So conversely, an owner occupied property may become an investment property and need to be carried at fair value. An entity should apply IAS 16 up to the date of the change of use. So it should treat any difference at the date between the carrying amount of the property under IAS 16 and its fair value as a revaluation under IAS 16. So having looked at that, we can look at an example to explain more on that. So an example is here. They're saying a business owns a building which it has been using as a head office in order to reduce costs. On 30th June 2009, it moved its head office functions to one of its production centers, and it's now letting out its head office. So company policy is to use the fair value model for investment property. The building had an original cost on 1st Jan 2000 of 250,000 and has been depreciated over 50 years. So they're saying at 31st December 2009, its fair value was judged at was judged to be 350,000. So how will this appear in the financial statement as at 31st December 2009? So we all know the original cost. The original cost was 250,000. So we are going to calculate the depreciation for the 9 years. So this 250,000 divided by 50 is the depreciation for the whole year, but we want for the 9 years, that is from 2000 to 2009, which is going to give us 45,000. So this is going to be the depreciation for the 9 years. Remember, when we to go back to the question that they had said the transfer occurred on 30th June 2009. So you're going to come here and calculate the depreciation of half of that year, which is depreciation to 30th of June 2009. Depreciation for the half of the year, which is going to give you, you're going to get this depreciation for the whole year. You're going to get the depreciation for the whole year, then times the 6 month times 6 out of 12. So 6 are the 6 month out of 6 out of the 12 months, because 12 out of 12 makes 1 year. So 6 out of 12, so meaning the 6, those are the 6 months. So which is going to give you 2,500. So having looked at that, you will now get the carrying value. So the carrying value, which is going to be cost minus accumulated depreciation. So this amount minus the accumulated depreciation of this and this, giving you the carrying value of 30th June 2009 as this amount here. So having looked at that, remember the fair value at 30th June 2009 was valued at this amount, which is 350,000. So the balancing figure will be a revaluation surplus, which is of this amount. So having gotten this amount right there, the difference between the carrying amount and the fair value is taken to a revaluation surplus in accordance with IAS 16. So however, the building will be subjected to a fair value exercise at each year end, and these gains or losses will go to the profit or loss. So if at the end of the following year the fair value of the building is found to be 380,000, $30,000 will be credited to the profit or loss. So thank you so much for watching. Make sure you subscribe to the channel.